What is a Lombard loan? This type of loan has become increasingly popular recently, largely due to crypto and borrowing against your crypto assets. Basically, a Lombard loan is a secured loan where you pledge financial assets like stocks, bonds, ETFs, or crypto as collateral to borrow cash. You keep your investments, you don't have to sell them, you keep their dividends and their upside potential while accessing liquidity without selling. In 2025, with volatile markets and rising interest in asset-backed financing, these loans are a go-to for high net worth individuals, business owners, and investors, really anybody with a lot of assets that would take a huge capital gains hit by selling or just doesn't want to sell for whatever reason. In this video, we're going to unpack in detail what Lombard loans are, a little bit about their history, which is actually pretty interesting, the mechanics of this financial instrument, the benefits, risks, and why they're surging in popularity. So let's dive right in. The concept, and I'm hoping you guys can guess this, but the concept dates back to medieval Italy, and there's the Lombardy region in Italy, where back in the 12th and 13th century, merchants and bankers known as Lombards lent against valuables like trade goods or jewelry to fuel commerce. These proto-bankers, precursors to the Medici, spread to Europe's financial hubs, embedding the term Lombard in places like London's Lombard Street, if you've ever been to London. They formalized secured lending. This is really a secured loan, right? Sidestepping usury bans, right? Because usury was kind of against the rules in Catholic countries up until like the 17 or 1800s. By the Renaissance, this evolved into structured, collateralized lending, influencing modern central bank facilities like the Federal Reserve's Lombard rate, a penalty rate for banks borrowing against securities. Today, Lombard loans are a sophisticated tool for leveraged portfolios without liquidating, especially relevant in 2025's market swings and tax pressures. So here's how they work step by step. Say you hold a $1 million portfolio, $600K in blue chip stocks, $300K in treasury bonds, $100K in S&P 500 ETF. You approach a lender like UBS or Credit Suisse or a specialist lender, and you pledge these assets as collateral. The bank values your assets using real-time market data, applying an LTV ratio, a loan-to-value ratio based on the risk. So depending on the asset, you might get a different LTV, maybe 80 to 90% for stable bonds, maybe 50 to 70% for equities, 40% for volatile funds. You might borrow 600 or 700K against your 1 million in capital or 1 million in assets, dispersed as a revolving credit line or a fixed term loan. With a credit line, draw only what you need, right? You don't have to draw down the whole 600, 700K. So let's say you draw down 200K for a property deposit to buy a house or something, and you pay interest only on that 200K. Your assets sit in a custody account, monitored daily via automated systems. If markets drop 10% and collateral falls to 90%, that would breach what's called the LTV cap, and then you face what's called a margin call. So you can either add collateral or repay part of the loan to reduce your LTV ratio, or you might risk liquidation, where you have to sell off your assets. This is also similar to like a margin call. Collateral quality dictates borrowing power. So here's what qualifies in 2025, and this changes all the time, but cash equivalents like money market funds or fiduciary deposits get pretty much like 95% LTV for stability. AAA rated government bonds fetch 80 to 90%. Investment grade corporate bonds might get 70 to 80%. Blue chip equities might get 60 to 70%. And these are kind of rough numbers, but it gives you an idea. It's like a sliding scale. Small cap or sector specific stocks might get 40 to 50%. Broad market ETFs and mutual funds might get 50 to 65%. Gold ETFs or structured products, maybe 30 to 50%, which seems low to me, but it's what it is. Life insurance with cash value can also be borrowed against, and that can be pretty high. It can reach 70 to 80%. And some REITs, 40 to 60%, depending on liquidity. Ineligible assets include illiquid private equity, collectibles, or unlisted startups. They fail the quote-unquote freely negotiable test. Diversification boosts LTV. A single stock portfolio risks lower ratios. AI-driven valuations used by banks like JP Morgan, they adjust it daily. The fact that they're getting more sophisticated actually allows you to fetch a higher LTV. The benefits make Lombard loans very compelling. First, liquidity without selling avoids capital gains taxes, which is really a big thing here. And capital gains taxes are very significant, right? In the US, it's 20%, but that's not even the highest in the world. In the UK, it could be 28% capital gains tax. Canada recently implemented a thing, I forget the number, I don't have it in front of me, but Canada just did some insane capital gains tax thing. I think Australia also did some insane capital gains tax thing, like 50% or 80%. I kind of forget, but you see where we're going with this, right? Plus, there's also the transaction costs and the lost compounding, which is sort of like a secret or secondary loss, right, that you avoid. Okay? If you sold 200K in assets, that could cost you 40K in tax. But a loan defers that, keeping your 2% dividend yield, which would give you like, say, 4K annually. And second, you actually are getting leverage too, which can amplify your returns. So let's just say you borrow at 4% and then you reinvest at 7%. You're netting 3% on that full position. Another benefit is flexibility. Credit lines charge only on drawn funds. Fixed loans offer predictability. Okay? These rates often even beat home equity lines. So this might be a better way to get liquidity or get leverage than borrowing against your house. And because typically what you're borrowing against is actually more liquid than a house. So it can be a lot better. The tax efficiency, again, is huge. It spans jurisdictions. There's things like the EU wealth tax deferral. Asia has holding incentives. Of course, there's short-term capital gains. There's also long-term capital gains. So the longer you can hold these things, you can potentially move your asset into being a long-term asset instead of a short-term asset, if you hold it for more than a year, more than 5 years, again, leading to a lower tax rate and more tax efficiency. There's a lot of real-world use cases here. So it's not just crypto, but crypto is definitely a big one. But people are doing this with tech stocks. People are doing this with all different assets. It's very popular for retirees. It's very popular for family offices as well, for refinancing existing debt. And you can tap into these loans against stocks to buy, say, private credit yielding 8 to 10%, beating the loan cost. So if you can get the loan, if you can acquire the debt cheaper than you can purchase new debt, say private credit, or in Mexico, you can get like 10% on bank deposits. A lot of countries in Latin America, in Ecuador, you can get like 10% on bank deposits in USD. So if you can basically borrow against USD for sub 5% and then invest in USD in, say, Ecuador for 10%, you're making a huge spread. There are risks, of course, which we should talk about. If there's a market crash, like say a 20% drop in equity value, that will slash your collateral value, and that may trigger a margin call. And with crypto, that's especially relevant in terms of the volatility in crypto. And sure, something like Bitcoin has less volatility than other crypto, but crypto can easily drop 50%, even for blue chip crypto assets. Okay? So don't get yourself in a bad position. Just because you're able to borrow 50% or 80% of the asset value doesn't mean you should. Currency mismatches are another things as well to be aware of. If you're borrowing in one currency and then investing in a different currency, you need to be aware of the swings in the forex rate. Another risk or concern would be over-concentration. Say if you're over-concentrated in one stock and there's that could lead to an LTV rate cut or an LT they would rather lend to you if you have a diversified portfolio versus if you just own $1 million of Apple. You're going to get a better rate and a better loan overall, a better Lombard loan if you have 1 million of the S&P 500 versus 1 million of Apple, for example. Okay. I'm also hearing on the risk side that regulatory scrutiny is growing. These countries are broke. They're using capital gains taxes to fund their insane deficits. And so they're kind of frowning upon Lombard loans because they're seeing it as a way for people to avoid capital gains taxes. And they want capital gains tax. They want people to sell assets. They don't want people holding assets forever. So this is something that I think is going to be increasingly in the spotlight in the future as capital gains taxes generally continue to rise around the world, that it's going to get more and more popular among borrowers and asset holders, but it's also going to get more popular among regulators as an area for potential scrutiny. Eligibility-wise, this really targets high net worth individuals, people with more than $1 million in liquid diversified assets and strong credit. There are retail versions emerging via apps and things for the retail crypto sector as well. It's historically really been a thing that the private banks have done. Banks like UBS and big banks around the world, but it's increasingly becoming mainstream. You can apply through a broker or an advisor, provide portfolio statements, and talk about your goals and how a Lombard loan might meet your goals. Underwriting can be very fast. Funding can be very fast because a lot of these assets are marked to market daily. So it's a lot easier to underwrite a loan against an S&P 500 portfolio than it is against, a house in Kentucky or something like that, right? It's easier, it's faster to get the loan underwritten. Anything that's more liquid, anything that's marked to market on a daily basis is going to bode well for this type of Lombard loan. Lombard loans are a strategic tool for liquidity, tax deferral, and growth. Rooted in history, but built for the modern era and constantly iterating as well in terms of how we're seeing this invade the crypto market. It can be an important part of your structure, your personal financial structure. And if you match this with something like a trust, a Nevis Trust, a Panama Foundation, it can have really interesting tax efficiency and asset protection benefits. Consult an advisor to model scenarios. If you want to speak to somebody quickly about this, there's a link in the description where you can book a call with us. We're ready to speak to you right now about Lombard loans and how this might fit into your personal financial structure, especially within the context of offshore. If you found this video interesting, please like, subscribe to the channel, and leave a comment if you'd like to share any anecdotes or build upon what we're talking about today. I hope you learned something, and we'll see you in the next video.